All right, let's talk about Oracle. You've probably seen the headlines, right? The huge stock jump, the eye-watering numbers. Well, today we're going to go behind all that hype to really understand the massive high-stakes gamble the company is making on the future of AI.
So it all kicked off right here. On March 11th of this year, Oracle's stock just exploded. We're talking a 15% jump after a blockbuster earnings announcement that really got everyone's attention. But what was the big news that caused such a massive rally? This number. This is what did it. The company revealed it has a backlog of future contracts, they call them remaining performance obligations, worth more than $500 billion. I mean, think about that. That is an almost unimaginable pipeline of future work. Now, on the surface, you're thinking, wow, this company is just firing on all cylinders. But what if those incredible numbers are hiding some pretty serious risks? What if the whole thing is a lot more fragile than it looks? Okay, let's really dive into this. So first, let's look at the bull case, the story that got everyone so excited and drove that 15% surge. It's all about Oracle's radical pivot. They're trying to become a landlord for the entire AI industry. So instead of just selling their traditional high-margin software, Oracle is now pouring billions into building the actual physical data centers. They're building the digital real estate and then renting out that space to companies that need a ton of computing power for AI. And wow, the first results? They look absolutely incredible. I mean, you can see their core cloud infrastructure, OCI, saw some pretty fantastic growth, but look at their multi-cloud database services. That spike is over 500% growth. On paper, it's a super compelling story. But, when a number is that big, you gotta look a little closer, right? That $500 billion backlog is where this story gets really, really complex. So let's peel back the layers here, because the details are absolutely crucial. So what's actually inside that massive backlog? Well, as this chart shows, it's not very diversified. A staggering $300 billion, that's more than half of the entire thing, comes from a single contract with just one company, OpenAI. This creates what people in finance call extreme concentration risk. Basically, Oracle's entire financial future, the success of this whole AI landlord strategy, is now completely tied to the health and success of one single partner. And this slide, this one really shows you the gap between the promise and the reality right now. So while they've booked over $500 billion in future work, the actual money they could bill for this quarter was just over $17 billion. There's a massive difference between having a signed contract and having the physical ability to deliver the service and actually get paid for it. So this huge strategic shift from their old business to this new one, it's not happening in a vacuum. To fund this incredibly expensive future, Oracle is having to make some painful choices, and those choices are creating some new vulnerabilities. We're seeing three big yellow flags here. First, their old bread and butter, that super profitable software business, is actually declining. They're cannibalizing their own cash cow. Second, and get this, for some of their new services, they're basically just tenants renting space in their rivals' data centers, like Amazon and Microsoft. And third, there's a huge obsolescence trap. With AI tech moving so fast, the expensive data centers they're building today could be outdated before they're even finished. Okay, so this whole pivot, for all of its amazing potential, is creating three major structural threats to the company's long-term health. And these aren't hypotheticals. We're talking about the cold, hard financial and physical realities lurking just under all that hype. Threat number one, cash. Over the last year, Oracle had a negative free cash flow of over $13 billion. To put it simply, the company is burning through cash at an alarming and, frankly, unsustainable rate. So where is all that cash going? Right here. They're planning to spend an immense $50 billion this fiscal year alone on what's called capital expenditures. That's just the money for building out all those physical data centers they need. Which brings us to threat number two, debt. To fund this massive build-out, Oracle has taken on an absolute mountain of debt. We're talking $135 billion. And that enormous debt load has pushed their credit rating dangerously close to junk status. Now, if they get downgraded to junk, the cost of borrowing all that money is going to skyrocket, putting even more pressure on their finances.
And finally, threat number three, just plain old real-world problems. It's not just about money. They're running into severe power grid limitations that are delaying projects. They're also fighting a class action lawsuit that says they misled investors about how fast they could build everything. And all this is happening while they're reportedly planning major layoffs just to free up some cash.
So, where does this all leave us? When you put the bull case and the bear case together, what's the final picture look like?
Well, it really comes down to this. Right now, Oracle is what investors call a show-me story. The market has priced the stock for absolute perfection. It's assuming every single contract gets fulfilled, every data center gets built on time, and every watt of power is delivered without a single hitch. And that leaves us with the ultimate question, doesn't it? The company's in this frantic race to build its AI future. But can it win its race against the crushing weight of its own debt, the blistering pace of technology making things obsolete, and the very real physical limits of our power grid? The answer to that is going to define the next chapter for this tech giant.